Hey guys, in this video, I share our November update of our $115,000 TFSA dividend stock portfolio. I'll share our 16 holdings and which stocks we bought to take advantage of the bear market. Let's do this! For those that are new to the channel, my wife and I do our finances together. We have 3 accounts through 2 brokerages for our TFSA, Scotia iTrade and Wealthsimple. As you can see in our Wealthbook account, the month of November has been good, but bad for our TFSA. We finished the month up almost 4% and are now only down 10% from our highs in April. You may be thinking, why has November been bad? The market is running up hard. Selfishly, we really hope the markets continue to get hammered back down. As you know, we like to reinvest our dividends into undervalued stocks that continue to grow their dividends. November saw the S&P 500 rally another 6% after a 7% increase in October, and the TSX 5% in November. Every Tom, Dick, and Harry is predicting when and if the market bottom has been reached. Are you getting sick of seeing every financial YouTube video entitled Fed Pivot? Well, I'm not going to throw a dart at the board and call the number. Instead, us dividend growth investors will just keep on accumulating discounted stocks while we can and ignore all that background noise. Let's get into the update and start as we always do with our one and only ETF in our TFSA, VFV, Vanguard's non-hedged S&P 500 Index ETF. Since selling off most of our position, we have not made any purchases. With VFV running up 8.5% since selling, it is really hard to buy back our position. Hopefully the market pulls back again come the new year so we can build this position back up again. Right now, VFV makes up just 0.2% of our portfolio. I have an allocation target of 5%, so we still have a lot of work to do. Next, Canoe EIT Income Fund is making up 2.8% of our portfolio. This income fund has performed very well so far this year, up 4% on the year, not including its distribution. With the distribution, this has returned 12.6% year to date, beating the TSX by 16%. The fund's many high-quality blue-chip stocks are presently in favor. And with a portfolio weighting of 21% in energy and 21% in healthcare, they have weathered the storm amazingly well. Next up is our second worst performer of the portfolio, Fiera Capital. It represents 4.1%. This remains on the chopping block as they will continue to struggle in a difficult financial market, in my opinion. They released Q3 at the beginning of November, and guess what? They were okay. AUM actually increased compared to Q2. Revenues of $161 million in Q3 2022 compared to $175 million in Q3 2021. So all in all, I'm still waiting for my exit price. I'll take my dividends in the meantime and invest in other better value positions. Next is Manulife Financial Corporation at 4.6% of our portfolio. We used to own a few stocks in the insurance industry, but no more. We have a 5% target weighting on this position. MFC reported Q3 earnings in November, and they were bad. I was surprised the market didn't react stronger than it did. MSC delivered core earnings of $1.3 billion in Q3, a decrease of 14% compared with Q3 2021. EPS, or earnings per share, was 68 cents compared to 80 cents last year. This brings its quarterly dividend payout ratio to 48.5% from 41% the previous year. We should have made some stock purchases back in October, as this has ran up 7.5% on the month. There are still some real risks in Asia with this holding, but it is manageable risk in my opinion. Next up, we have Telus Corporation at 4.8% of our portfolio. This is one of 2 in the telecom sector for us. We have a target weighting of 6% for each of our telecoms, so we have some work to do with this one. Telus reported earnings at the beginning of November. They were great, and it showed how they have pricing power to beat inflation. Revenue was up 10%, EPS 17%, and total mobile and fixed customer growth of 347,000. Bam! We have quite a ways to go before this balances with our BCE holding though. We bought 4.2 shares at an average price of $28.79, adding $5.90 to our forward annual income at a yield of 4.9%. And hey guys, if you want to see our entire TFSA dividend stock portfolio and all the trades I do live, like the shares I bought of Telus, you can download Blossom Social for free. I've been pretty active on it, sharing my thoughts and insights on my holdings and other dividend growth stocks or market news. It's a really cool place to share investment ideas with other Canadian investors. The app is like a combination of Instagram and Twitter. Check out the link in the description if you're interested in that. Now back to more stocks we bought. Next is our OG utility, Fortis. It represents 5.5% of our portfolio. This has been a strong performer for us over the years, despite being down 9% this year, not including the dividend, of course. After selling off $1,200 worth in September, I want to add back more to balance it out with CPX. Fortis ended the month up 2.5%. We bought one share for $53.32, adding $2.26 to our forward annual income at a yield of 4.2%. I'm looking forward to dripping a share next month as well. Next up, we have BCE Inc. at 5.7% of our portfolio, about 0.8% more than our Telus weighting. We have a target allocation of 6% still. It remains a core holding of our turf model. BCE is now up 14% from its low in October. Q3 earnings were good, just not as good as Telus. Adjusted EPS was up 7.3% to 88 cents. FCF, or free cash flow, was up 13% and had record quarterly mobile phone net additions of 224,000. Surprisingly, BCE performed much better on the month despite not increasing its dividend as Telus did. If you're liking this video so far, please hit that like button for our master, the algorithm. Let's try to break 100 likes. Next is our ugly duckling utility, Algonquin Power and Utilities Corp. This is our renewable energy play. This now makes up just 3.9% of our portfolio, down from 5.7% last month. Algonquin became headline news when it released Q3 earnings at the beginning of November. There was this massive sell-off of 19% on the day of the release, followed by another 14% the day after. It is now down 44% year to date, and there was no bounce the last 2 weeks of November. I read through the earnings report, as well as the MD&A, Management Discussion and Analysis, and I'll be sharing a short video of my thoughts. Make sure to hit the subscribe button if you don't want to miss that video. We purchased 15 shares at an average price of $12.93, providing us with over $14.10 of forward annual dividend income at a yield of 7.8%. Next, we have our OG pipeline, Enbridge, at 7% of our portfolio. ENB made up some ground this month, up 4.5%. It reported Q3 earnings in early November, and they were good. Some takeaways were the DCF of $2.5 billion, or $1.24 per common share, compared with $2.3 billion, or $1.13 per common share in 2021. That well covers the dividend. The company reaffirms its 2022 financial guidance, which includes adjusted EBITDA between $15 billion and $15.6 billion, and DCF per share between $5.20 to $5.50. And at the end of the month, they announced an annualized common share dividend increase from $3.44 to $3.55 per share, or 3.2% effective March 1st, 2023. Oh yeah, baby. I love me some more dividend increases. Next, we have another one of our midstream pipelines, Pembina Pipeline Corp. It represents 7.1% of our portfolio. It reported Q3 earnings as well. They were strong as expected. Revenue was up, earnings doubled, and guidance for the year was boosted again to about 2%. Some big news was that beginning in 2023, Pembina intends to move from a monthly to a quarterly common share dividend payment. They also have repurchased 6.3 million common shares since December of 2021. All really good signs. It is trading up 17.5% since the low in October. It's only 9% off of its 52-week high now. Pembina Pipeline has outperformed the market drastically, up 27% year to date, not including the dividend. We have made no purchases, as this is already over our 5% target weighting. Next up, we have SmartCentres Real Estate Investment Trust at 7.1% of our portfolio. This REIT is another staple in our turf portfolio. This is overweight for our liking, as we have a sector allocation of 15% for REITs, and right now we're sitting at about 20%. We consider SmartCentres to be one of the top 4 REITs in Canada. It reported Q3 earnings in November, and they were okay. One highlight is the payout ratio relating to cash flows provided by operating activities for the rolling 12 months ending September 30, 2022 was 86.6%. as compared to 96.8% for the same period ending September 30th, 2021. Also, they now have 185 properties, with 19 under development. Compared to Q3 2021, they also have 5.8 million more units outstanding. That's not good. As for price, it ended the month up 2.5%. We bought 0.1228 of a share at a cost of $27.28 a share. This added a whopping 23 cents to our forward annual dividend income. That's almost a quarter, man. Next, we have Tfsa Energy Corp at 7.7% of our portfolio. This increased 20.5% from its 52-week low in October, only to fall again another 11% or so in the next few trading days. Like most of the stocks we own, TRP reported Q3 earnings in November, and they were nothing special. One thing stood out, and it was what the CEO mentioned. He said, "We expect our fully sanctioned secured capital program to deliver a 2021 to 2026 comparable EBITDA compounded annual growth rate of 6% that will support our expected 3 to 5% annual dividend growth, funding of capital commitments, and reduction of our overall leverage metrics." I hope personally they hover closer to the 5% than the 3% range for some good compounding. We bought 0 shares at these price levels. Next up, we have First National Financial at 7.9% of our portfolio. Despite the drop in net income for Q3, FN increased its monthly dividend by 2.1%. The stock ran up with the market 6% in November. This should stagnate at these price levels for a long time by my reckoning with these elevated interest rates. We were able to grab 2 shares at $33.13, adding $4.80 to our forward annual income at a yield of 7.2%. Next up, we have our mid-cap utility, Capital Power Corp, at 8.5% of our portfolio. This is on a tear, trading up 13% since the lows of October. It is up on the year now 24%, not including its dividend at the time I recorded this. With this running up so much, I may trim this position to add more to Fortis, balancing the two out. We bought 2 shares at $42.78, adding $4.64 to our forward annual income at a yield of 5.4%. Next up, at 9.7% of our portfolio, is Bank of Nova Scotia. This is our second largest holding, though I still wish it was TD Bank. The share price finished the month up 6.5%. Q4 earnings were released at the end of November. All big banks are reporting over this week. The earnings were worse than I thought. Year over year, there was a marginal gain on EPS. But for the quarter, Ichiwawa caramba! EPS was $1.63, down from $1.97. And revenue was down 20%. I'm sure no one would have been surprised by no increase in the dividend, as the payout ratio is now over 50%. We still decided to buy 1 share at $65.87. That added $4.12 to our forward annual income at a yield of 6.3%. I still believe BNS is undervalued. At the same time, we need to build up a position in either TD or RY when the opportunity presents itself. And now, our largest holding is still RioCan Real Estate Investment Trust at a whopping 13.5% of our portfolio. This has remained our largest holding since the pandemic. RioCan has been on a tear in November, up 11% at one point, and ended the month up 8%. What a roller coaster this year has been for anything other than energy producers. As I mentioned in my TFSA income update, Q3 earnings were good, and they reaffirmed 2022 FFO per unit growth guidance of 5% to 7%, and are expecting to be at the higher end of that range. The FFO, or funds from operations payout ratio of 56.7%, was in line with long-term target range of 55 to 65%. We can now anticipate another modest dividend increase next year, inching closer and closer to the previous distribution of 12 cents a month. We were able to drip 2 shares at a price of $19.68. That added $2.04 to our annual forward dividend income at a yield of 5.2%. So there you have it, all 16 holdings and what purchases we made this month with our dividends. We deployed a total of $628.85, adding $38.09 to our forward annual dividend income this month at an average yield of 6.1%. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. Until next time, I'm Mr. Financial.